Average true range or ATR. In today's session, we will be understanding what is ATR or average true range, and we'll also be looking into what are the different ways it can be used when it comes to trading. So very good evening to all of you. Welcome to another YouTube live session with me, Surjit Kakkar. Today is Wednesday, 26th of Feb, 2020. And like I already said, the topic for today would be ATR or average true range. Now, before we move ahead, let's get done with the formalities. So make sure you pause the video and go through the disclosure. It talks about the representations, the risk disclosure, the risk involved in the market, and also about the copyrights. So to understand average true range, the first thing, let's talk about what is the definition of average true range. Now, the definition might be a little complex, but as I move forward, I'll make it very simplified for you. So what is average true range? The average true range ATR is a technical analysis indicator that measures market volatility by decomposing the entire range of an asset price for that period. Now, I know it can be more, a little bit difficult to maybe understand this, but like I said, as I move forward, I'll make it very simplified for you so that you people can understand what is ATR or what is average true range. Now, to understand average true range, the first thing we need to understand is what is true range, because once we understand what is true range, then we can calculate the average of that true range, which is called as the average true range. So now let's imagine that we are on the daily time frame, right? So it can be on any time frame. ATRs can be used on any time frame, be that 1 minute, 5 minute, 10 minute, 15 minutes. And I'm just taking as an example that let's assume that we are looking at a daily chart, and this is a candle on the daily chart. Now, because whenever you see a candle, the candle gives you 4 different data points. What are those 4 different data points? From a candle, you get to know the open, high, low, and close. So let's assume that the opening price for this day, right? So because I'm saying we are taking it as an assumption that we are looking at a daily chart. So let's assume the opening price for the day was 100 rupees. And from 100 prices, they went down and created a low of 99. From their prices, they started moving up and created a high of 104. And at the end of the day, we closed at 103. So these are the 4 data points which we get from a candle, which is your open, high, low, and close. Now, the first thing I need to know is what is my true range. So what is your range of the candle? The range of the candle is always from the high to the low. And that is what is called as your range of the candle, from the high to the low. So to calculate your range, what we will be doing is we will simply be doing mathematics, which is we'll be subtracting from the high price the low price. So what is your true range? Oops, just give me a second. Perfect. So what is your true range? Your true range is high minus low, and in this case this would be 104 minus 99, which tells us that my true range is 5 rupees. So what this is telling me is that on this specific day, the stock made a move which from the low to the high was a move of 5 rupees. So whenever we talk about whenever we talk about the true range, right? So the true range is basically the range of that candle for that specific period. Like in this case, we are talking about a daily chart. Now, if I'm looking at a 5-minute chart, then it's going to be how much did the price move in that 5 minute. If I was looking at a 15-minute chart, how much did the price move in that 15-minute, right? So it's just the range of the price move from the low to the high in that specific interval. So now that we understand what is the true range, now it is easy for us to calculate the average true range. So let's assume I'm looking at a chart and a stock did something like this, that from the low to the high, this is how it moved on one day. The next day it moved something like this, the next day it moved something like this, the next day it moved something like this, the next day was something like this. So let's assume I'm calculating an ATR of 5 periods. So that is why I have taken 5 candles here. You can see candle number 1, candle number 2, candle number 3, candle number 4, candle number 5. So this is going to be the latest candle, which is today. This is going to be yesterday. This is going to be day before yesterday. Now this is going to be one day before yesterday, right? So we're just going back in history. So what we are doing is that if you look at this day, the range of this candle was from the high to the low was 5. Now the next day the range can change. So you can see that this day from the high to the low, it moved a little bit more. And for this day, the range was 6 rupees. The next day, the move was a little smaller. And that is why from the high to the low, my range for this day is 4.5. For the next day, again, you can see it's a very big move from the high to the low. Maybe that range for this specific day was 7. And for this day, the range is, let's say, 3.5. So now if you want to calculate the average, it's simple mathematics. We'll add all these numbers. So we got 26, and because we have 1, 2, 3, 4, 5 observations, we'll divide it by 5, which tells me that based on the historic data, in the last 5 days, on average, this stock is moving 5 rupees 20 paise, right? That is what this calculation is telling me, and that is why it is called as an indicator which helps you understand the volatility of that stock. So it is telling me that the stock on average moves around 5 rupees 20 paise based on the last 5 observations on my daily time frame. Now let me apply it to the chart and let me show you as an example what is an ATR. So let's go to the daily time frame. Then we'll also look at it on different time frames. So all you need to do is go to the indicator list, search for ATR, and you can see you'll be able to find average true range, apply it. Now by default, whenever you are applying ATR, you will see almost on every platform the ATR gets applied to 14 period. Here you can see if I go to the settings is 14 period. So what is 14 period basically means that from the current candle, it's looking at the last 14 candles. So this is what it is doing. So the way I showed you the calculation for 5 candles, it is doing the calculation for 14 candles. So what is this telling me? That this script, which is Nifty, if I point here on the last candle, let me do this, right? So can you see it is telling me that this script, which is Nifty, on average is moving 138 rupees 0.81 paise based on the last 14 days observation, right? So it's not based on 1 day or 2 day because it is applied as a 14 period average. So it is telling me based on the last 14 days, on average, it is moving 138 rupees 0.81 paise. Now, if I apply the same thing on a smaller time frame, let's say I go to the hourly chart, right? Now it is telling me based on the last 14 hours, because now it is looking at 1 hour candle and we are looking at the last 14 candles. So now it is telling me on average we are moving around 49 rupees and 18 paise. So this is where you can see the numbers, right? 49 rupees 18 paise. Now if I change this to, let's say, a 15 minutes chart, so on a 15 minutes chart it is telling me that every 15 minutes on average, looking at the last 14 observations, we are moving around 27 rupees 5 paise, right? So that is what it tells you, that what can be the expected volatility of any script based on what has happened in the past. Now, how can this information be used? Now, this information can be used in n number of ways. So I'll show you different ways how it can help you maybe identify your entries. I'll also show you some ways how it can be maybe used to identify your targets, and maybe how you can even use it as your trailing stop loss, right? So we'll talk about different ways it can be used. So there are n number of ways it can be used for your entries, for your targets, for your stop loss. Different traders will be using a different way. So I'll just show you some examples how it can be helpful. So that you get a little bit of idea, how probably you can put it into your trade plan if you wish to use it. Now let's look at this example. So I understand, okay, let me do this first. Let me make it first very simplified for you, and then we'll look at it with this real life example. So let's assume that, let's go back to the same example which we were seeing, where we had a stock which opened at 100, moved to 99, made a high of 104, I guess, and then closed at 103. So that stock, when we did the average, we got an average of 5 rupee 20 paise. I guess that was the average of the last 5 days. So let's assume that today, or because today the markets are already closed, let's imagine tomorrow. So let's imagine tomorrow this stock opens up at let's say 110 rupees. So if this is where the stock is opening up, and we understand that on average, based on the historic volatility, the stock is moving around 5 rupees 20 paise. So what can happen is, if it keeps moving up the whole day, the maximum we are expecting it to go is 115 rupees 20 paise. How? Because we did 110 plus 5 rupees 20 paise, which was my average. Similarly, if it keeps going down, then it can go down to, I'll do the mathematics. Let's see, what do we get here? It will be 110 minus 5.2, which is 104.8, right? So if it keeps going down, we are expecting it to go 104.8, right? So this is telling me, based on the historic data, what is my expected volatility, and based on that expected volatility, what am I expecting from the script? I'm expecting the maximum it can go today is maybe 115.20. The lowest it can go is maybe 104.80. So now what I can do is, whatever methodology I might be using, because I'm not expecting it to go beyond this, and similarly I'm not expecting it to go below this. So let's assume if you are using support and resistance, maybe you can try to identify support and resistance level which are closer to this. So this is called as your playing field, right? Because this is the range in which we are expecting this stock to move. So let's imagine if you have a support area or a resistance area which is really far away, we know that probably it might not come to those levels. So maybe I should be looking at something which is within this range. Another example is, maybe if you're looking at some Fibonacci levels, maybe you would be interested in levels which are within that range. Another example is, let's say if you are waiting for some candlestick patterns. So let's say if the prices, they reach this high and then you see some bearish patterns, or it reaches this low and you see some bullish patterns, probably those can be your signals to maybe now enter into trades. So let's take now a real life example. So let's imagine we are looking at Nifty and we can see that Nifty is moving around 138.80. So what I'll do is, just to make it simplified, let's call it as 140. So I know because it is moving 140, so what can happen is tomorrow at whatever price it opens, because we don't know what price it will be opening. Nifty can gap up 50 points, can gap down 50 points, can gap up 200 points, can gap down 200 points. So we do not take it from the previous day close. We always take it from the next day opening price. So let's assume that tomorrow it opens at 11,700, right? So once it opens at 11,700, what can happen now is, because my ATR is 140, that is what we are assuming. So we can expect 11,700 plus 140, which means the maximum we are expecting it to go is, let's take a horizontal, let's take a horizontal line. Just give me a minute. Give me a second. Perfect. And we are back. So that's the shortcut key. So yes, what I'm expecting is maximum maybe it can go is 11,840. So 11,840 would be somewhere around, in fact what I can do is I can make it easy for me, 11,840, right? And similarly the minimum I'm expecting it to go is maybe that 11,700 minus 140, which is 11,560. Right, so let's take again give me a minute, I'm using the incorrect shortcut key, I apologize for that. So let's get back again, and there you have it. Right, so yes, the lowest we are expecting it maybe 11,560. So let's put it at 11,560, 11,560. So now this becomes as my trading, my playing field. So what I'm expecting is that tomorrow, probably that's the maximum it can go, that's the minimum it can go. So if I'm trying to find some opportunities, maybe I would be more interested in going short. The closer I'm getting to this high level, and the closer I'm getting to these lows, I will be more interested in buying. So this is one way how you can use the ATR to identify your playing field. And then based on whatever methodology you're using, be that demand supply, be that support resistance, be that Fibonacci levels, be that chart patterns, be that candlestick patterns, right? Whatever your strategy is, at least this can give you a little bit of advantage, because now you know that if you're looking for some opportunities, if they are within this range, high probability maybe you can get a trade the same day, otherwise you might not get it. So that's an example of how it can be used for your planning your trades or planning your entries. The other way, like I said, it can also be used as for your targets. Now, example can be, because I know it moves around 140 points in a day. So let's say I was planning a trade on a 60-minute chart, and let's assume that I went long. Now, because I went long, and maybe this is what I'm seeing as my area of resistance, and I'm taking this as my target. Now, if this target is more than 140 points away, probability is high that I might not be getting the target the same day. So what I can do is I can try to find a target which is, let's say, even before the ATR, because if I'm having a target which is before the ATR, the probability is high that I might get the target the same day. So this is how you can also understand whether the target which you're looking for, what is the expectation? Can you get the target the same day, or you're not expecting to get the target the same day because maybe it is very, very far away, maybe it is twice the ATR or thrice the ATR, right? So again, that is also a way where you can try to understand whether your target is reasonable to be achieved as an intraday trade, or whether it is not reasonable and it might be very far away, you might not get it the same day. So here, that's an example of how maybe ATR can be used for your targets. Now, at times what can also happen is maybe your target is very, very close by, and the ATR is telling you that yes, maybe you can have a move which is much bigger than what your target is, and then maybe instead of booking your target 100%, you can book, let's say, 50% or partial profits, and balance you can trail for whatever the ATR is. So that's an example how the ATR can be used for your targets. And before we get into stop loss, yes, I would also like to add that I'm doing approximately 3 sessions per week. The Sunday session is fixed. We do it around 10 to 11 on Sunday morning. But these sessions which I'm doing, generally the timings are not fixed for this. Whenever I have time, in fact today I wanted to do it at around 5 p.m. but then again I got occupied, so I'm taking it at 7. So but otherwise the timings are not fixed. So how would you get notified? To get notified, make sure you subscribe to my channel, hit the bell icon, select all notifications. 10 to 15 minutes before the session starts, I start with a countdown timer. So that is gonna give you a notification that yes, the session is about to start in about 10 minutes or in about 15 minutes. And if you are available, yes, you can join live. In case you're not available, then at least you will get the notification that today a session happened, and later you can watch the recording for it, right? So make sure you subscribe to my channel, hit the bell icon, and yes, if you're liking these sessions, hit the thumbs up button, share it with your friends. And yes, if you want me to take some topics, make sure you put it in the comment section. I am noting down the topics which I'm getting from you people, and slowly and steadily I'm taking those topics one by one. And yes, I would also like to add that I'm taking these topics both in English as well as in Hindi. So today the session was in English, the next session would be in Hindi. I'll be taking the same topic in Hindi as well. Alright, now the last way, not the last way, again, there can be many more ways how the ATR can be used, but another example how I can use ATR is maybe for your trailing stop loss. Now an example can be, let's say I'm trading on a 15 minutes time frame, and let's assume that today at the fill of the gap or whatever, I took a short trade. So if I took a short trade and now I want to trail that short trade, so let's assume I went short maybe somewhere around here because it was almost close to the fill of the gap, and then I got maybe a bearish candle which was a bearish engulfing, and then I went short, right? I'm just giving you an example. So if I did something like this, now what I can do is I can try to see that on average how much does this stock moves on this specific time frame, and we can see that on average it moves around 22 points. So if my stop loss is less than 22 points away, what can happen is prices can come back and stop me out. But if my stop loss is beyond 22 points away, the probability of me getting stopped out will be a little bit less. So let's assume if I went short here after this candle got completed, so let's assume that you went short here. So your 22 points would have been 11,753 plus 22. So you can have your stop loss at 1177.75, right? So let's do 1177.75, somewhere around here. Now what you can do next is, as prices they keep moving further, now this candle has closed. So what you can again do is, because you know on average the stock moves around 24 points, because now you can see that your ATR is 23.30. So what I can do is that from this closing I can again calculate my stop loss level, which will be 11,721 plus 24 points, which is 11,745, right? So now I can push it to 745, which is somewhere around here. Now again I can wait for the next candle. So similarly you can do something like this. So it's just an example. So some people might be using whatever the ATR number is, some people might be using 1.5 times the ATR, some people might be using maybe 2 times the ATR. So that completely depends upon your trade plan. But this is also an example where if you want to trail on to your positions, you can even use ATR as a method, because you understand that this is the average volatility. So if my stop loss is more than that average volatility away from wherever the current market price is, my probability of getting stopped out will substantially reduce, right? So that's a way how you can even use it as a trailing stop loss if you wish to. But yes, whether you should be using the ATR, whether you should be using 1.5 times the ATR or 2 times the ATR, that will completely depend upon your trade plan, your purpose of trade, your methodology, because every trader has a different personality style. Some people are conservative, some people are aggressive. But yes, those are few of the ways how the ATR can be used. So we talked about what is ATR, we understood the mathematical calculation about it, we understood how ATR can be used to calculate your playing field, and then you can plan your entries within that playing field to have higher probability of getting the fill. You can use ATR as your trailing stop loss. You can even use ATR to identify your targets. So these are just some of the ways how ATR can be used, but yes, there can be many more such uses of ATR, right? But I just wanted to cover a few of them just to give you some examples. Now you can think about many other ways how probably it can help you with your specific trade plan. All right, now let's get started with the messages we have in the Q&A tab. So let's see what do we have here. All right, so yes, a very good evening to all of you. So can we use any indicator just to find out trend in demand and supply methodology, or need to find trend manually? See, again, when it comes to demand and supply methodology, the first thing you will realize is that we do not give a lot of importance to trend, right? So trend does not have a lot of weightage, it has very less weightage. So generally what we are doing in demand and supply methodology, we are just trying to trade from zone to zone, from demand to supply, from supply to demand. That is the reason trend does not have a lot of weightage. Now, because it does not have a lot of weightage, whatever methodology you're comfortable with, if you're comfortable with identifying trends using some moving averages, yes, you can use moving averages. If you feel more comfortable using trend lines, you can use trend lines. If you feel more comfortable using the projected trend analysis, you can use projected trend analysis. If you're more comfortable using the price action, which is higher lows, higher highs, lower lows, so whatever is your comfort level, you can use that. And the reason for that is because anyhow we do not give a lot of weightage to trend, so it doesn't matter what methodology you're using. The fact is, even if you don't even want to do the trend analysis, that is also perfectly fine. It's just that in our scoring we will give it a score of 0 because we are not doing the analysis for the trend, and that takes care of it, right? Because now we have already reduced the scoring for our boosters because we know we are not doing the analysis for the trend. So it's not a very big deal. Whatever is comfortable for you, that is what you can use. All right, so how to enter a trade before big move or ATR about to rise up. So Anant, now this is something which you will see happening at your demand and supply areas, because demand and supply areas are where you have those imbalances, and wherever you have those imbalances, the moves can be much bigger than the average move. So that is why, in fact, let me see if I can show you few examples of some trades which we did this week. So let me bring that up for you. Just give me a second. Let me bring this up. So what I'm doing is, what happens is that in the POS Plus course, I share some trading ideas with the students. So I'm just showing you 1 or 2 trading ideas which got triggered this week. So let me bring this up so that you can see that when prices, they come to your areas of demand and areas of supply, that is where you can get these big moves from. So I'll show you one example, which is India Bull Housing Finance. Let's bring this up. Let's go back to the charts. iBull Housing Finance. iBull Housing Finance. So can you see, this was a trade which we planned on the 23rd of Feb, and prices came into the zone on the 24th of Feb. So can you see, early in the morning prices, they just touched the zone and we got a really nice move from it. Now if you look at the ATR here, so if I add ATR, you can see that the average true range is around, at this point of time, we have an average true range of about 5 points, right? 5.5 that we are expecting prices to move 5 rupees 50 paise. But can you see, as soon as it hit the demand area, look from the low to the high. The low is around 25, the high is around 50. So we have a 25 points move, which is 5 times the average move. Why? Because this is where that imbalance was, and because that is where the imbalance was, we can expect moves which are much bigger than the ATR. And within the first few minutes, we got our target on this. Can you see, prices just touched, gave you a nice move. Then again, it came back to the zone at the end of the day. The next day, again, we gapped up. And now the zone has been tested multiple number of times and eventually it got violated. But yes, coming back to your question, that how can we identify areas from where we can get these moves which are much bigger than the average move? Those will always happen at points of imbalances. And those points of imbalances are basically your areas of demand and areas of supply. All right, so let's get back. So good, at least I was able to show you an example where the move was at least 5 times the average ATR. All right, demand and supply, on which time frame we should use? See, again, it can be used on any time frame. Let me see how to use it in supply and demand method. Okay, so let me first cover one question which I forgot, how to use it, demand and supply methodology. The fact is, it's not going to give you any edge in demand and supply methodology. Why? Because I just showed you people who do not know how to identify imbalance. Wherever they are participating, they might be participating at areas where we don't have imbalances. And if you don't have imbalances, the move can be the average move. But when you know how to identify areas of demand and supply, and that is where those imbalances are, the moves can always be much bigger than the average move. So that is why ATR to us does not give us any edge when it comes to demand and supply methodology. But yes, if you're not using demand and supply methodology, you're using other things, yes, maybe ATR can help you there, but with demand and supply, it's not going to give you any edge. Maybe one thing you can do is probably playing field, but that is also where it's not going to give you a lot of edge, right? But yes, other than demand and supply, maybe it can help you a little bit because you don't know how to identify those imbalances. All right, so how to enter, just answer that. How to use it in demand and supply, just answer that. Demand and supply, on which time frame we should use. So this is from Ahmed. The fact is, it doesn't matter whether it is a 1 minute chart or a 5 minute chart or a 15 minute chart or a daily chart or a weekly chart. It can be applied on any time frame. It's just that based on your purpose of trade, are you planning an intraday trade? Are you planning a swing trade? Are you planning a position trade? You will be using different time frames, but whatever time frame you might be using, demand and supply methodology can be applied. There is no restriction to it. In fact, let me show you another quick example. So I showed you India Bulls, right, which is on 15 minutes. Now let me also show you a trade which we got on the same day, and that trade was on a 5 minute chart. Now can you see this was on a 15 minute chart? There was also a trade which is Castrol India, CSTROL, and can you see now this was a trade which was planned on a 5 minute chart. Let's wait for the charts to load up, and there it is. Can you see this was planned on the 18th of Feb. Prices came back on the 24th, and can you see after hitting this again we got a really nice move from this area. So can you see I showed you two examples, one on a 5 minute chart, the other one on a 15 minute chart. So it doesn't make any difference whether you're trading on a 5 minute chart or on a 15 minute chart, as long as you are able to identify something which matches with your trade plan. Yes, you can always use it as your areas of demand and supply. All right, so let's get back. All right, so again, time frame is not a restriction. All right, demand and supply, so just answered that. Now let's see. ट्रेडिंग व्यू में जब आप टारगेट मार्क करते हैं तो रिस्क रिवॉर्ड मार्क करने में प्राइस राइट साइड में कैसे आता है? सो आई एम नॉट एबल टू ओके, सो यू सेइंग जो टेक्स्ट लिखा होता है वो राइट साइड पे आता है. आई गेस दैट इज व्हाट यू आर टॉकिंग अबाउट. So what you can do is you can go to my website, and on my website under the free tab there is a link which says trading analysis. Click on that, and there is a video provided. Just go through that video. It tells you all the settings for TradingView, for all the tools which we are using, and that is going to help you with those settings. So not to worry, just watch that video. Is Nifty entered today into a demand zone in daily chart? So Bajrang, what you can do is I do sessions on Sunday where we try to identify where are the key demand and supply areas on some of the major markets, in which we do cover Nifty and Bank Nifty. So you can watch the previous Sunday session where I would have marked where are the demand areas and supply areas on Nifty, and that is going to help you understand where are those levels. All right. सर आपकी एक ओके एंटर्ड. ऑल राइट सर, आपकी एक इम्पॉर्टेंट मेल मैंने पढ़ ली है. ओके, I will be the next Rajit Kakar Vishma. All right, wishing you the very best. I hope, see, that is what I would love to see, right? If I'm coaching people, I would love to see that people reach a point where they can move to the next level, right? And they can also help other people understand the same strategy and even coach them using the same strategy. So I would love to see that. All right. So explain the difference between ATR and DATR. So the difference between ATR and DATR. See, ATR, what is ATR? If I was on a 5-minute chart, it was telling me the ATR of that 5 minutes time frame. If I was on a 10-minute chart, it is telling me the ATR of that 10 minutes time frame. If I'm on a 60-minute chart, it is telling me the ATR of the 60 minutes time frame. DATR stands for daily ATR, which means irrespective what time frame you will be on. Just give me a second. Just a second. Alright, so irrespective whatever time frame you're on, the DATR will only tell you the ATR of the daily time frame, right? That is what DATR is all about. So even if you're on a 5-minute chart, it will show you, like, when we were looking at Nifty, the ATR on the daily chart was approximately 140. So even if I'm on a 5-minute chart, it will show me 140, which is my daily ATR. So that is what DATR is all about. All right, so let's see what do we have next. Thank you so much for your time. You're most welcome. How to trade in crude oil using NCPSEC or commodity trading. See, the fact is, whatever you are trading, if you're trading the Indian market, you should be looking at the MCX chart. If you're trading the international market, you should be looking at the international chart. That is how simple it is. So if you are, I'm pretty sure, because you're from India, Manoj, you will be trading the Indian markets. And if you're trading the Indian markets, just look at the crude oil chart on the MCX. And based on that, wherever the areas of demand and supplies are, or wherever your strategy might be, you can apply the strategy on the MCX chart. Yes, if you want to add a little bit of more weightage to it, a little bit of edge to it. Yes, you can correlate with the international chart as well, which means based on your strategy, if let's say you're on the demand zone in the MCX and you're also in a demand zone in the international market, higher probability, right? But otherwise, even if you just lean against the MCX chart, it's more than sufficient. And so one demand supply zone video, please. Shri Krishna, I'm already doing demand and supplies every Sunday, right? Every Sunday we look at Nifty, Bank Nifty, S&P 500, gold, silver, crude oil, and some forex script where we are identifying where are the areas of demand and we are identifying where are the areas of supply. And I've been doing it almost for a year now. So if you go to my YouTube channel, you will see recordings available for almost a year where we are planning everything well in advance, right? So you will have all those sessions available to you. Why market goes volatile when true range goes or stays above ATR? See, again, like I said, the market does not move because of the ATR. Market moves because of orders, right? So wherever that imbalance of big orders would be, the markets can give you moves which are much bigger than the ATR, right? So again, ATR is not the factor because of which prices they move. In fact, I did a session when we started some time back when I started doing these sessions almost thrice a week. And the name of that topic is, I guess, why do prices move? So just go and watch that video, why prices they move. And that is what is going to help you understand that prices they move because of imbalance between your demand and supply. And due to which prices they move. Yes, if the imbalance is big, the move can be much bigger than the ATR. What's the logic behind that? Yep, so I just told you I have already done a session on it. So do watch that session. That is going to help you understand that logic. So you're not using volume candle, how to identify the big boys involved or not. See, volume does not give you any edge. I also did a session on volumes. So that session is already available on YouTube. So just watch that session. That is going to help you why volumes do not give you any edge. So we have already covered this topic, that does volume give you any edge when it comes to demand and supply strategy, and that is going to help you with that specific query. When you're using MCX, okay, charts for levels on Sundays. So the reason why am I using that is because on TradingView we do not have the MCX charts, right? So that is why I have no choice, because I want to cover gold, silver, and crude oil. I'm using the COMEX chart. That is what I'm doing, because we do not have the data feed for MCX on TradingView. All right, so that brings us to the end of today's session. Thank you so much for joining in. I'll again be seeing you very, very soon. And make sure if you want me to take some topics, put it in the comment section. I will be taking those topics slowly and steadily. And thank you again for joining in. Until we meet next, take care. And also, yes, share these videos with your friends. And yes, if you're liking these videos, do hit the thumbs up button. Thanks again. Take care. Bye-bye.